Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello, and as always, I'm going to take you on a tour of markets and run through the most important charts and themes we're seeing today. So let's start out by talking about that huge inflation report and what a difference a year makes. We have expectations coming into the report of 3.1%. And when I polled Twitter, people were thinking it's going to come in above that expectation, actually come in higher than 3.1%. But instead, we had a number that actually came not just below it, but actually slightly below 3%. So 2.9% on the overall CPI. Market seems to like that. Saw a rally in stocks following that report. And we saw, importantly, the core rate of inflation, something obviously the Fed is looking at closely, move down as well, now below 5%, 4.86% on the core if we're excluding food and energy prices. So the trend over the last year has been in one direction and one direction only, that's down. So 12 consecutive declines in the rate of inflation in the US, from 9.1% in June 2022 to 3% today. And what's driving that decline in the rate of inflation? Well, the rate of inflation of all the major components pretty much are moving lower, with the exception of shelter. Every other major component is either flat, so food away from home is flat, or down. Everything, all the other categories down here. So if we're looking at the energy component, we're actually seeing outright decline. So fuel oil, gasoline, gas utilities, you're seeing lower prices for consumers than they had a year ago. And used cars as well, still down year over year. The other categories are still up year over year, but at a slower rate of change. And the important one that I like to always talk about, food at home. So this is something that's been front and center for everyone. You go to the grocery store every week and we're seeing this unrelenting increase in prices. Prices are still going up, but at a much slower pace, now below 5% on that food at home category. So let's talk about shelter. We know shelter is the most important factor for CPI. It's over a third of the index. And why is shelter showing a higher rate of inflation this year versus last year, while everything else is showing a lower rate of inflation? Well, as we've talked about every single month, shelter is a lagging indicator. It's taking into account data that occurred months ago. It's not looking at real time prices. And because of that, you see a lag between the actual things like rents and rate of change in rents and the shelter CPI. So rental inflation peaked a while back and has been decelerating for some time. We're actually seeing over the last year rent prices actually down slightly in the US year over year. But shelter CPI won't take that into account for many more months, the current data. But finally, we're seeing a deceleration in terms of the shelter CPI component. We peaked a few months ago at 8.2%. Now we're at 7.8%. And I suspect the back half of 2023 will see a more significant decline, just like we saw with rents with a lag months ago. So, what we're going to see here in the next few months is likely still trying to close this gap between what actually happened in terms of rents and what was reported in terms of shelter CPI. So we could still see positive month over month increases in shelter CPI because again, it's being reported with a lag. But that rate of change is likely to come down, and when it does, that will be helpful for overall CPI and especially for core CPI because shelter is such a major component there. So if we look at things that we were talking about a few months ago in terms of food prices, and not many people talking about today, but we have to give the update, and this is very good news. Things like eggs, way down, and so over 50% decline for a dozen eggs. We were at 482 for a dozen in January at the peak, and 222 today. Much better place for egg prices, and hopefully we'll see that with other food prices as well. We want to see that food price inflation really come down. So if we're looking at the path to prosperity, this is the way back. You have to have wages outpacing inflation. And unfortunately, for 25 consecutive months, we didn't have that. We had the opposite. That's why everyone was so negative about the economy and consumer sentiment last year. because their wages weren't keeping up with these rapidly rising prices. But now, finally, we're starting to move in the other direction. Wages went up in the US over 4% over the last year, while prices were up 3%. So we want to see that continue in the coming months, and hopefully it will. And that's something the Fed has been watching, as I've talked about, pretty closely. I'm sure they wanted this to shift back into positive territory before they stopped hiking rates. And now here we are. But interestingly, the market's saying the Fed's not done quite yet. They're actually going to hike one more time, and they're going to stay higher for longer than market participants had thought. But why is it so interesting that the Fed is hiking rates in a few weeks? Well, it's because we're seeing just this persistent decline in inflation, not just with CPI, with PPI, with imports, with exports. Actually, imports and exports down in terms of prices on a year-over-year basis. And so why does the Fed feel like they have to hike? I'm not quite sure. If you read into the minutes and you hear the comments there, I think they're still focused on core and thinking it might be stickier there. So I think this is kind of an insurance policy for the Fed, saying the economy is doing pretty well, employment seems to be pretty good still. Let's do one more hike just in case we see a resurgence in prices in the coming months. Then at least we have that hike in place, and after that, markets thinking the Fed will stop. So real-time inflation, this is important because, again, CPI, especially the shelter component, is lagging. So Trueflation does this real-time assessment, and interesting, it's still going lower here, down to 2.1%. So not far away from that Fed target of 2% for the inflation rate. A year ago, if we look at last July, we were above 11% for this metric. So a long way down, a great thing to see. Hopefully it stays down. Hopefully this trend continues. But if we're talking about the Fed, pretty much a done deal in terms of the Fed hiking one more time here, 5.25 to 5.5%. That would be the highest rate since 2007. And when the market probabilities are this high, pretty much know the Fed's going to do it. I'll do my tomorrow's news today in a few weeks, and I'm going to say the Fed's going to hike as long as the probabilities are this high, because the Fed has always done since 2009 exactly what the market has expected it to do. So why is the Fed feeling comfortable here? Well, again, they don't really have to hike again because of inflation, but they're not yet worried at all about employment. So we got another good employment report. Unemployment rate still sitting there at 3.6%. A few months ago, it hit a 54-year low of 3.4%. So if you're looking at the employment market, the Fed, I think, is still saying, well, we have a pretty tight labor market still. We still have 1.6 job openings per unemployed person. So we might as well err on the side of being a little bit more restrictive than maybe we need to be, in case that, again, that inflation number starts to go up again. So what are the current expectations, and what has the shift been in terms of that expectation? Well, a few months ago, the market was saying Fed's done in May. They're going to pause, and that's it. They're going to start cutting interest rates actually starting in later this year, let's say September, October. These probabilities shift all the time. But where we are today, very different picture here. Again, market saying they're going to hike in July, so one more hike than what was expected. But then, interestingly, the market's now saying the Fed's going to stay higher for longer. We're going to see that Fed funds rate stay up here for the remainder of the year, and the Fed is not expected to cut rates until 2024 at the end of the first quarter. I think the last thing I saw was maybe March of next year we'd see a rate cut. But interesting that the market's now seeing that. Perhaps that's a sign that the market is saying that recession probabilities have been pushed back. We won't see a recession this year. Remember, we were talking about, well, why would the Fed be cutting rates this year? And the big reason for that would be if we saw economic weakness. If we start to see those employment numbers weaken significantly, well, then the Fed would be likely to reverse course. But if we're not going to see that, again, the Fed can focus more on that inflation mandate. And this is a big shift in policy from where the Fed has been over the last decade, which is almost always in that easy monetary policy area. So if we compare the Fed funds rate to CPI, we have been saying for a while that the Fed was going to hike until the Fed funds rate crossed above that CPI, and it's likely to cross over with the CPI coming down and the Fed funds rate going up. That's what happened. But now we have the Fed funds rate above 5% and likely to still go higher with that next hike. And we have the inflation rate at below 3%. So that spread here of 2.1% is actually the highest we've seen. You have to go all the way back to 2007 for a period where we had that real Fed funds rate above 2% without the Fed being at zero. So we saw briefly in 2009 it go above this level, but the Fed back then was at zero. And is this a shift? Is this the end of easy money? That's what people should be asking. Are we going back to a monetary policy regime that's more normal based on the history of this? And if you look at the history of this, it's been the Fed funds rate would be, during economic expansions at least, would be above the rate of inflation that happened throughout most of the 1990s. And we saw after the tech bubble burst, we saw the Fed cut rates back down to 1%, and at that time that was a record low. But they took rates up from 2003 all the way to 2006, hiking rates and pushed them back above CPI. What was different about the expansion following the recession in 2008, 2009 is that the Fed didn't start hiking rates when the expansion came about. They held rates at zero for 7 years and didn't start hiking until the end of 2015. And when they did so very slowly. And so it took until 2018 and only happened for a brief moment for the Fed to get back above that inflation rate. And then we had 2020 and COVID, Fed cuts rates to zero. And now it's taken some time, but we're back above that CPI level. So the question is, how long is the Fed going to remain restrictive? They're talking the talk. If you listen to Powell, he's saying that they're going to remain restrictive as long as it takes to be sure that inflation is going to come down to their 2% target. But that remains to be seen whether that actually occurs. Right now, the Fed, I think, will leave it there because markets are doing well, the economy, labor markets are doing well. But what happens if that changes? Will they start to change their tune? So we'll have to wait and see what happens there. But if we look globally at inflation rates, you could see the trend for the most part is lower. And so it's not just the US, but the US certainly, if we look at US versus Europe or other areas, US inflation now has come down a lot faster than, let's say, than Europe, especially looking at UK, stuck at 8.7%. We're all the way down to 3%. So that's important for monetary policy because the Fed is thought to be almost done with hiking rates. They already have a central bank rate above CPI here. So they have a positive real Fed funds rate. Here's the US over here, above 2%. But Europe here, if we look at the Eurozone, still in negative territory. So the expectation is that Eurozone still has work to do. The UK, Bank of England still has work to do. Probably a few of these other banks as well. If we look at Sweden and Norway and perhaps Australia, has more work to be done. So US was more aggressive in hiking and started earlier than many of these areas in terms of their tightening policies. And now the U.S. is closer, it seems like, to the end of the tightening regime, while these other areas are still playing catch up. And you can see here the real central bank rates, we went to them being almost negative across the board when inflation spiked everywhere, to now more countries with a positive real Fed funds rate. And as I've talked about, if you look at emerging markets, particularly Brazil and Mexico, they're going to be in a place to cut rates. They could probably cut rates at the next meeting if they wanted to. I don't know if they will, but we're getting closer to the point where this gap between their central bank rate and inflation is high enough where they're likely to feel comfortable to start to ease policy again. So emerging markets moved first, then the US, then if we looked at the ECB, and now we're likely to see the same in terms of who cuts first. It's likely to be some of these emerging market countries. Again, we've talked about China already. easing policy going against the rest of the world. That's likely to continue with their reported inflation rate being down to zero, and talking about economic weakness there, and concerns about property sector and manufacturing output and the rest of it. So China's likely to continue easing, and we're likely to see some of these other countries like Brazil and Mexico start to ease as well. So let's talk about the equity market. And as we said, equity market, nice bounce on the CPI report. That's been a trend over the last few months. Inflation comes in better than expected. Markets respond very well to that. And what we've seen now in the S&P 500, one of the best starts we've seen in history, 17.5% gain through the first 132 trading days. So pretty big advance here in a very short period of time. With the exception of 2019, this is the best start to a year we've seen in the last 20 years. So we saw a few of these in the 1990s. If you look at 1995, 1997, 1987, of course, everyone remembers what happened there. But pretty good start here to a year. And as we talked about, nobody was expecting this coming into the year. And what we had said coming into this year, the question was, would this be the first year where the S&P 500 didn't hit an all-time high since 2012? And it looked like the odds of that happening were pretty high coming into the year. We were a good ways below that all-time high from January 2022. And so when I did this poll earlier in the year, a lot of people said no all-time high this year. It's not going to happen until next year or the year after. Did this poll again with the S&P around 7% below its all-time high. Now more people are starting to believe we're going to see it this year in 2023 and keep that streak running. So what has the S&P 500 done now? Since the October low, it's rallied over 29%. So we're at over 4,500. The low back in last October was below 3,500. So huge move higher here. And now we're only 6%, I think, away as of today from that January 2022 peak. So could we do it this year? Absolutely. Perhaps we're going to start to see weakness here. We haven't seen a correction really since this period over here. And remember the banking crisis that no one's talking about now. So usually you have a few corrections a year, not always, but likely to see another correction at some point. Could that happen soon? Who knows? We'll see. We're just starting to enter earnings season. Perhaps that'll be a catalyst. Perhaps it'll be something else. But the point being, we're within reach of that all-time high. It would not take very much, I think, to push the market above there. And more interestingly, I think, is what the market now has done since the Fed started hiking rates in March of 2022. So March 16th, 2022, the Fed lifts rates off of zero. And if you listen to the commentary when they're hiking every meeting here, it was this saying, don't fight the Fed. You don't want to be in the market as long as the Fed is hiking rates. And for a while, that seemed to work. The S&P did go down a good amount last year, well over 20%. But now it's come back, and on a cumulative basis, it's actually positive up since the Fed started hiking rates in March 2022. So this is actually, and I've talked about this is actually more typical of what usually happens when the Fed is hiking rates. The market tends to go up on average during rate hiking cycles. So this notion that the market can't go up because the Fed is hiking rates, throw that out the window. Market absolutely can. And now I think surprising most people is now positive since we're 500 basis points higher on the Fed funds rate, with at least one more hike coming, and the market is higher than where we began. And so certainly a very interesting thing to see. Now, what has happened to sentiment? As you might guess, we talked about the sentiment picture last October many times, how negative it was back then. And one of the most bullish things for the market heading into this year was the fact that nobody was bullish. Everyone was bearish. And that sentiment is really starting to change. And what's driving that is especially the performance of what I've called the enormous eight, the big tech leaders, Nvidia, Meta, Tesla, Amazon, Netflix, Apple, Microsoft, and Google, all up now over 40% on the year. Nvidia tripling, more than tripling on the year, best performing stock in the S&P 500. So the whole AI mania has continued here, and this is this is causing market participants to be a lot more enthusiastic. If we look at active manager sentiment, so this is actual exposure reported by active managers, so their exposure to the equity market, and we compare it to last October, we've seen a complete reversal. So last October, S&P 500 is at 3,500, and managers, or active equity managers, are saying they have less than 20% exposure to stocks. Now we have the S&P 500 above 4,500, so at over 1,000 points higher. And guess where active manager exposure is? It's above 90%, highest level since November 2021. So as we always talk about, equity market is a weird animal. It's very different than retail, where we recently had Prime Day for Amazon. They're kind of a Black Friday event, and everyone's buying on Prime Day because you have these huge discounts. So you have more demand. People are happier, more bullish, so to speak, on buying retail goods when they're discounted. That's not the way the stock market works. People get more enthusiastic about the stock market when stocks are at higher prices. So where else are we seeing improved sentiment? Well, we're seeing that consumer sentiment report from the University of Michigan start to move higher again. We talked about it last year, hitting a record low. We had never seen it that low, which was kind of a strange thing because the economy wasn't in a recession and we had sentiment just plummeting. And what was the reasoning behind that? Well, it was all about inflation. It was all about wages not keeping pace with that inflation. But as wages start to outpace inflation here, we're seeing confidence starting to be restored here. This is the highest level we've seen since September 2021. It's not just the inflation picture. I'd say that's the biggest part of it, but I think it's also continued strength in the labor market and, of course, the stock market, right? When the stock market's doing better, people are talking about it and they're feeling better. So one by one, we're looking at these sentiment indicators and people are starting to embrace it. Really, that wall of worry that persisted throughout last year and early this year has really been torn down. I think there are certainly some skeptics still out there, but much fewer in number. And as long as stock prices continue to go up, I think you're going to see sentiment continue to improve. Let's talk about the what's going on with government spending and the national debt. And there's a saying, drunken sailors spending like drunken sailors. Where does that come from? I think it dates back to the late 1700s, early 1800s, when sailors used to come ashore and they had been away at sea for a long time, and they would go on a spending spree and naturally spend a lot of their money. But drunken sailors were at least limited to the amount that they had, right? They weren't like the US government, where there seems to be an unlimited amount of funds because the federal government can print money and they can borrow money. And boy, are they borrowing money here since that debt ceiling has been suspended. We had 31.4 trillion in debt before that debt ceiling was suspended, and we said, yeah, it has to be lifted. You can't have a huge deficit, $2 trillion plus deficit, and have a ceiling. It has to be lifted. But I don't think anyone expected the debt to increase this quickly following the ceiling to be suspended. It was going to increase because you have all of that built up spending, and we weren't borrowing for that period after the debt ceiling was hit. But a $1 trillion increase in a little over a month, I think, is exceeding people's expectations. We're at almost 32.5 trillion in national debt today. $1 trillion increase in a little over a month. And what's driving a big part of this? Well, it's simply we're spending way more than we're taking in. If we look at the national deficit, if we look at what's government spending exceeding the tax revenue and other revenue that's coming in, That increased again in June, and now we're at 2.3 trillion in terms of a deficit, just a huge, enormous deficit, given that the economy is still technically in an expansion where GDP was 2% last quarter and is expected to be 2% again this quarter. That's been the average over the last 20 years. And we have yet this, we still have this massive deficit in spite of that. So my question would be, well, what's going to happen if the economy turns down later this year, early next year? And is there going to be a push again to do this massive fiscal stimulus that people like to do during recessions? What's that going to do to the deficit? Perhaps we're going to see this widen even further. So, not sure about that. Perhaps that'll change as well. But one thing that we are pretty sure of is that as long as interest rates stay high, and as long as we keep adding debt at the clip we're adding, we're going to see this number go up. And this is the interest expense on public debt. It's 852 billion over the last year. That's another record high. And again, when this was low, everyone was saying, don't worry about the national debt. We can service it. The interest rate is so low and the interest payment so low as a share of GDP. But very quickly, the math on this is starting to change. And I think this trend will continue, obviously, as long as interest rates stay up. And now we just added another trillion in debt. So we got to service that as well. And we could see this sometime in the next year or two surpass Social Security as the biggest line item in the federal budget. So that's something to chew on. That's something for people to think about. Do we really want to continue down this road where servicing that debt becomes harder and harder? And I guess the question people in terms of the Fed will be asking is, well, how are they going to keep interest rates above 5%, keep tight monetary policy given this backdrop? How are they going to keep it up there for very long? Are they going to resort at the end of the day to cutting rates again, to going back to quantitative easing, because we simply can't afford to have interest rates that high? And so that obviously brings other problems as well. If you start buying that debt and you start suppressing interest rates and letting inflation run hot, but the question will be, or will they be forced to do that at some point? We're not yet there today. For now, still the concern is inflation, but at a certain point, people are wondering, is the Fed going to bring rates back down on this pressure from the government to say, hey, this interest expense is simply too high. You have to step in and bring it back down. So we'll see. But for now, the trend is higher and higher. And it doesn't seem to be anybody calling this out as a potential problem. All news seems to be good news, even with more debt, because in the short term, as we've talked about, more debt can be a very good thing. So part of the reason why the economy is growing and people are feeling good, and we'll talk about the in this next section, the manufacturing construction boom. Part of that is because we're financing it. We're not paying for it. People aren't being taxed more. They're being taxed the same, but we're spending more because we're borrowing it. In the short term, that feels very good. So interesting thing here, we have a manufacturing downturn. So if we look at the ISM survey we get every month, it's at levels where in the past few times we've been at these levels, we've been in a recession. Now, 1995, 1996, we saw even lower levels than today with no recession. So it's not a guarantee that we're going to see one, because manufacturing is not a huge part of the U.S. economy anymore. But interesting to see the U.S. manufacturing PMI showing a contraction in output for a number of months. But at the same time, you have manufacturing construction spending, so new factories being built at a record high and just surging over the last year, 76% increase year over year. What's driving that? Well, there's a few acts that were passed that are really driving this. You have the CHIPS Act, so semiconductor manufacturing, huge stimulus there. I think it was 50 billion or so. You had the Inflation Reduction Act as well, and there was a set asides in there for to build manufacturing output in the clean energy space. So that's a big part driving this higher. It'll be interesting to see if this has a meaningful impact in terms of U.S. manufacturing power. And certainly part of the drive to do this was to have more energy independence and obviously have more independence when it comes to something as important as semiconductors and not be as reliant on overseas for that critical input. So it'll be interesting to see what the end result of this. But for now, this is contributing to GDP, right? We're borrowing money. We're not taxing to get this money. We're borrowing it and putting it back into the economy, building these new factories. So let's talk about used car prices. This is the area I've been shocked that has not come down more so far, but perhaps finally we're going to see another leg lower. So we saw a pretty good decline last year in terms of used car prices, but in the first few months of this year, they started moving back in the opposite direction. But over the last 2 months, we've seen a move back down again. Now this Manheim used car index, which measures wholesale used car prices, it's at its lowest level in a few years. So I think the peak to trough decline now is around 16% and change. The used car index is important because it's a leading indicator of retail prices, similar to looking at wholesale prices for eggs. So we saw that collapsing in January and February, and we said it's only a matter of time before you see lower prices at the supermarket. Well, here, if this continues, you're going to see lower prices at the dealerships. And so leading that move lower in terms of used car prices has been Tesla. And there's a number of reasons driving that. The biggest one is simply that Tesla cut its prices dramatically entering the year, huge price cuts and over 20% across the board, and a shift in supply to lower price models. So Tesla really has changed their objective in the short term. You've heard Musk talk about this, but really the objective now is to gain market share, and they're willing to compromise on margins and profitability to just get more Teslas on the road and have more of a network effect. And so it's pretty interesting to see that now, if you want, it used to be known as kind of a luxury vehicle brand, and now the average price of a used Tesla is down to $43,900. That's a $24,000 decline from the peak average price last July. That's a sizable move in a pretty short period of time, a 1-year period. We saw this huge move lower in the average price of a Tesla. So if you've been waiting for to buy a Tesla, but the price wasn't affordable, well, certainly much more affordable nowadays. And we saw those Tesla production numbers. They just released them last week for Q2, and they did explode higher. There was a huge surge in demand, and no doubt lower prices were part of that. But what's interesting about the last few years in terms of used car prices has been the impact it's had on insurance companies and insurance rates. So this is a chart showing you the annual increases in car insurance rates. And what you can see there on the right side is they're moving up and moving up at a rapid pace, 17% year over year. That's significantly higher, obviously, than the inflation rate at 3%. And there's a number of reasons driving this, but the biggest one is simply insurance companies have been losing money on their car insurance. So one example would be State Farm is the biggest car insurer, lost $13 billion on its auto arm last year. And what's driving that? Well, there's been more accidents. Repair costs have gone way up, and big driver has been that huge surge in used car prices. So used car prices are up over 40% since the beginning of 2020. So you get into an accident, your repair, replace those parts, replace the car. Well, now it's costing the insurance company so much more. If they're not increasing the premium to account for that, they're going to lose money, and that's really what's happened. And so, unfortunately, we're all going to be feeling this in terms of the next few years. We've already seen a big spike. If you saw your auto policy renewed, you probably noticed that, but that's likely to take a few years because insurance is dictated by the state regulators, so they have to get permission for price increases, and usually they only approve a certain amount. But over the next few years, they're likely to catch up and do that with higher premiums. So interesting side effect on the inflation front, where inflation in the used car market is causing inflation in insurance with a lag here that could continue. So perhaps this is one of the things the Fed is looking at and saying, we're not done yet in terms of breaking the back of inflation. So let's talk about earnings, and we'll do it quickly because next week we're going to see many more earnings, but we got a few, and so far the few that we got, it's beat. So expectations were certainly better than they were last quarter heading into earnings season. I think last quarter very low because we had seen negative year-over-year growth for the preceding few quarters. People thought that was going to continue. Well, that didn't happen. That was a big catalyst for the markets. Now people have raised those expectations, but at least the first few reports, companies are still beating. So three different areas here. We have Delta. We've talked about the travel boom. Well, here you go. You have Delta posting a record quarterly profit, beating expectations, hiking their outlook. You have Pepsi beating estimates, even though prices are hurting demand. They're still able to raise those prices. They still beat on earnings. And JP Morgan Chase, and we talked about how they bought First Republic at a huge discount. It was really a windfall for JP Morgan Chase, making billions and billions of dollars off of buying those assets on a cheap. And lo and behold, they're beating analyst expectations. And it's really interesting to see the winners and losers in that banking sector. But overall, what are people expecting in terms of this quarter? Well, this is the spreadsheet from S&P Dow Jones that I look at, and what they're saying is GAAP earnings, so as reported earnings, are expected to be up 7% year over year for this quarter. So that would be the second consecutive positive quarter following these three negative quarters for growth. And market, if that's the case, I think even if it comes in as expected, that would, I think, surprise people to the upside. And as you can see here by these numbers, at least these are S&P Dow Jones numbers, people are thinking this is going to continue. People are thinking we're going to see earnings come right back and continue to increase on a year-over-year basis. And by next year, we'll see a new all-time high in terms of GAAP earnings. So earnings peaked here end of 2021. $53.94 on GAAP earnings, and the expectation is we're going to surpass that in 2024. And the stock market, of course, is a forward-looking indicator. So perhaps stocks are saying, at least for now, that earnings are going to continue to move up. And what you'll notice here is multiples are expanding again. If you look at PE ratio on these as reported earnings, you can see 25 times at the current S&P level of 4,500, and that's up from where we were last year. So we had that discount in terms of the 27% decline in the S&P. Well, now the S&P 500 was rallied 29%, and we're seeing multiple expansion again across the board. So very interesting that 2023 has been the polar opposite of 2022, which was the polar opposite of 2021. And speaking of polar opposites, if you look at like dividend payers versus non-dividend payers, we're actually seeing slower dividend growth. So we got the number for the second quarter, up 3% year over year. That's the slowest we've seen. You have to go back to 2021. But the interesting thing in the first half of this year is that dividend payers underperformed non-dividend payers by a huge amount. And what's driving that? Well, it's really the trade of growth and value. So growth stocks in the first half of this year, if we look at the Russell 1000 ETF, the IWF, we're up 29%. We have value stocks here up 5%, right? And that's the polar opposite of what happened last year, where value stocks were down 7.7%, growth stocks down 29%, and on and on and on if you look at the year before that. it was a few years before that it was growth, obviously, and growth has been on a tear. If we look at the last decade plus, so this is since 2011, the annualized rate of return for growth stocks 14.7% versus 9.8% for value. So just a huge spread in terms of growth over value. And it looked like, at least for 2022, okay, maybe we're going to see a reversion to the mean. We did see it with value stocks outperforming, but it didn't last very long. Led by NASDAQ 100 and tech, growth stocks have become roaring back. So we'll see what happens in the back half of the year. This is unusual strength for these types of stocks. You very rarely see this type of rapid increase in this short period of time. So we caution people who are thinking that this could continue. If the NASDAQ 100 continues at this pace, there's only 1 year that really comes close to it. It would be 1999. So could we see that again? Perhaps, but yeah, the odds are pretty low of having another 1999, I would say, but certainly not impossible. There is no impossible in markets. If it happened before, it could happen again. But I think it's shocking to me, shocking to a lot of people to see this resurgence in growth so quick and after what we saw last year. So market is always surprising you, and here's just another example of that. So let's talk about mortgages and the mortgage predicament. So we got that 30-year mortgage rate bumping up close to 7% again. And what this means is housing that was already unaffordable is even more unaffordable. So I looked at the recent report from Redfin, had a good chart there showing you what you could afford at different levels of mortgage rates. And at that 2.65% rate back in early 2021, a $3,000 monthly payment. So this includes, this assumes 20% down, 1.5% for property taxes, 0.5% for home insurance rates. So it assumes not just the home price, but a $3,000 payment would buy you $640,000 home. Today, that 6.95% mortgage rate with that same $3,000 payment is going to get you a $444,000 home. And never mind the fact that home prices are actually much higher than they were back then. So you're going to need a bigger down payment as well. But the math here is showing you a huge decline in purchasing power over a very short period of time. And the shocking thing, though, is that this hasn't led to a huge decline in prices. This is one of my biggest surprises for the first half of the year that I talked about on the last video, but we're actually seeing now prices up on a year-over-year basis. This is data from Redfin. So for a while we were down year over year, but just slightly. Now we're actually positive year over year for the first time since February. And it's just incredible to see that, given where mortgage rates are compared to a year ago. And what's driving that? We've said it many times, but we'll say it again: the lack of supply. So demand has come way down because of that affordability picture, but supply has come down as well, matching that decline in demand, it seems like. And so we have the number of active listings here just way lower than a normal level. It had been low last year, but it's even lower this year. And what we said, what's driving that? Well, it's simply people with very low mortgage rates not willing to give that up. And if we're looking to buy a new home, that affordability math that we just talked about really doesn't work. So for now, this is leading to kind of a stalemate in terms of buyers and sellers equally matched here. We'll see how long this can continue. I don't suspect that we're going to see prices continue to rise from here, but I guess until that supply dynamic changes, we're not going to see huge declines. You just simply need more supply. We're starting to see that with new home building, but that will take time for those homes to be built. What you really need is existing home owners to start putting their homes on the market as well. So let's end here, as we always do, with a positive thing. And the positive thing is where we are today compared to last year when I showed this chart. So last June, last September, I showed this chart showing you the worst 6-month periods for the broad equity market, so the Wilshire 5000 in history. And what we said was this is one of the worst periods, and that we can't tell you what's going to happen over the next 3 months, 6 months, even 1 year. But looking out further than that, the odds from these big declines, historically at least, has been that you'll be rewarded, that long-term investors who stick with their portfolios or continue buying during these periods of time will be rewarded over time. And now we have 1 year's worth of data on that end of June reading from last year. Actually saw a 19% increase, so not bad so far. The September reading, we don't yet have a 1 year mark just yet, but that looks to be positive as well. And for investors, long-term investors, this they should remember these won't be the last time we see these big declines. Another big decline is coming. We don't know when. It could happen next year. It could happen in a few months. It could happen starting tomorrow. But when it does, keep this chart in mind. Keep the long-term perspective in mind. Ignore kind of what happens in the short term and understand that the upside of downside is that you're actually getting the ability to buy in at a lower price, at a lower valuation, which oftentimes leads to better long-term returns. So we'll end it right there. Thanks everyone for joining. If you like the content, as always, subscribe to the channel. Have a great weekend, and I'll see you next time on the Weekend Charts.